Hi everyone, welcome to the Chosun Ilbo's Asian Leadership Conference webinar. I'm very pleased to host and moderate today's webinar, which is about strong dollar and global economic outlook. So before we begin, I'd like to thank Chosun Ilbo for hosting this wonderful event and for continuous support in reaching out to the best experts for the panel discussion. Today, we are discussing a very important and timely topic. So, as the $1 exchange rate soars sharply due to the recent aggressive interest rate hikes by the Federal Reserve, it is said that the era of King Dollar has arrived. Not only the US interest rate hikes, but also inflation and Russian invasion of Ukraine are raising warnings about the economic crisis in Asia, South America, and Africa, as well as in Europe, where developed countries are concentrated. So in this Chosun Ilbo Asian Leadership Conference webinar, we discuss the impact of the current US interest rate hikes on the global economy, including Korea, and the possibility of an economic crisis becoming a reality. So, for today's webinar, we have three outstanding speakers who have a deep understanding of the current state of the economy. So, all of them are not only top class scholars in the field, but also experts in advising economic policy with a lot of experience. So the first speaker is Dr. Mark Spiegel, who is a senior policy advisor in the Economic Research Department of the Federal Reserve Bank of San Francisco. He is also a co-editor of the Journal of International Money and Finance and won the Sun Yat-fang Award, the top Chinese economic prize in 2016, proving him an expert in the Asian economy. And the second speaker is Dr. Ayhan Kose, who is a chief economist for Equitable Growth, Finance and Institutions, and the director of the Prospects Group in the World Bank. He is also a non-resident senior fellow at the Brookings Institution and research fellow at the Center for Economic Policy Research. Under his management, the Prospects Group produces the bank's corporate flagship report, Global Economic Prospects. The last speaker is Professor Jinill Kim, who is a full professor at Korea University with a lot of publications in top academic journals. He also used to work at the Federal Reserve Board as a senior economist. So given his ample experience both in the US and Korea, he will be exactly the one who can provide the insight we are looking for. And I'm Sangyeop Choi, an associate professor at Yonsei University, who is moderating the panel discussion today. So let's get straight into our panel. So the first topic is global inflation. Now, inflation is everywhere, maybe except for my paycheck, which gives a hard time for consumers as well as firms facing higher pressure on their wages. So, Dr. Kose, given your deepest understanding of global inflation dynamics, I have to ask you first. So, Dr. Kose, what is the main cause of the current surge in inflation worldwide, and how long do you think this high inflation would continue?
Thank you, Sangyeop. This is great panel, and I'm very pleased to have these distinguished colleagues joining today. It's a privilege to be here. Uh, Obviously, global economy is going through a very difficult period. Uh, in the context of inflation, when you think about what happened since early 2020, it has been a really a roller coaster ride. We had this early stages of the pandemic between January and April 2020. Inflation really collapsed. It was low, but declined by about 1 percentage point as we saw this, the sharp dive in global demand, and you saw the plunging in or plunging oil prices and commodity prices in general. So then you came to May 2020, and since then, global inflation started to pick up. We have a sharp rebound in oil prices, the food prices, and then, of course, this uh, rapid recovery of activity following the easing of the lockdowns that had been introduced during the first wave of the pandemic. a number of countries provided aggressive support measures on the monetary policy side, on the fiscal policy side, that fueled inflation. And finally, this year, what happened is that you had the surge in commodity prices uh, from the Russia's invasion of Ukraine and renewed supply disruptions because of course, the pandemic outbreaks, especially at the beginning of the year, and now still supply interruptions in China, pushing up basically the inflation levels. Um, Now, when you look around the world, what you see, inflation is running at 3-decade high at the global level. This is, the highest since 1990. If you look at emerging market developing economies, inflation is at the highest level over the past 15 years. In emerging developing economies, around 10%, at the global level, around 9.5%. And in the advanced economies, the story is even uh, more difficult to digest because it's around 9%. It's 4 decades high, the highest level since 1982. And when you look at inflation forecast, for example, for this year, at the beginning of the year, people were thinking inflation was going to be around 3.5% this year. Now we think that it's going to be above 8%. And for next year, obviously, inflation forecast expectations picked up. When you look at the regions, especially emerging developing economy regions, Europe and Central Asia saw significant pickup in inflation because of course, the disruptions associated with the war in Ukraine and the commodity price surge. In the case of East Asia Pacific, inflation pressures were lower, but wherever you look around the world, you see that inflation targeting economies have higher inflation than their targets. So, all in all, we know the reasons. I think we have a pretty good sense of those reasons. On the both demand side and supply side, there were forces pushing up inflation. Did we expect the inflation was going to come to these levels? No, but given the kind of the circumstances, we need to find ways to basically cope with inflation. Back to you.
Thank you. So indeed, inflation is so global, and you also mentioned that it's pretty much a combination of demand and supply factor. So perhaps in your fancy cutting edge economic modeling, is there any way to tell us a relative importance between the supply and demand factors driving the current surge in inflation?
When you think about inflationary forces, uh, the recent pickup in inflation, uh, demand factors played a role, commodity prices played a role, especially of course oil prices, and the supply factors played a role. And I think that if I'm going to assign quantities, I would say that the both demand and supply factors played significant roles, and the commodity prices, especially for headline inflation, were critical. There are different studies providing different numbers. We spent quite a bit of time, of course, the global inflation, and there, Sangyeop, the big driving forces were really demand and the commodity prices. At least in our models, we don't see the supply-related factors playing the type of role, we read in the press. But at the end of the day, you know, these factors were quite critical. Supply related disruptions, especially early in the pandemic, and then they were persistent. But those types of disruptions have been moderating recently.
Thank you. So, then what is the, we've been talking about the cause of inflation. Then, what is the most important consequence of high inflation? And also, inflation expectations also seem to rise quite fast. And the thing that I'm teaching my student is that not only inflation level per se, but inflation expectations toward the future plays an important role. And as an economist, we all know that it's in the Fisher equation, New Keynesian Phillips curve, oil equation, and everything. So, do you have any comment on this front, Dr. Kose?
Yeah, this is very important. Of course, if we want to think about inflation, as much as we spend quite a bit of time on analyzing, the current inflation, recent inflation numbers, we need to think about expectations. Ultimately, the central banks would like to keep inflation expectations anchored. What happened since the beginning of the year, inflation expectations picked up for this year as well as next year. For advanced economies, uh, for this year, uh, as I already told you, picked up significantly. For emerging developing economies, by the end of the year, it's going to be close to 10%. Um, for next year, for advanced economies as a whole, around 4%, for emerging developing economies, around 6%. Uh, so that in this year as well as next year, you see a significant pickup in inflation expectations relative to where we were at the beginning of the year. Now, what is important is if you look at inflation expectations over a 5-year period, for example, call that long-term inflation expectations, they are still quite stable. So you don't see a kind of a huge the anchoring of inflation expectations in the context of advanced economies. Now, that is quite critical for emerging market developing economies. Our work here at the World Bank shows that in the case of advanced economies, long-term inflation expectations do not respond to changes in inflation. So the sensitivity of these long-term expectations to the developments, what is inflation, going up, going down in the short time period, uh, basically quite small. In other words, inflation expectations anchored. Now, when you look at emerging market developing economies, the sensitivity of long-term inflation expectations to changes in current inflation has declined over time. So they have, in a sense, done a better job in terms of anchoring inflation expectations. But still, these long-term inflation expectations tend to be quite sensitive to developments in, the current inflation numbers. Now, what does this tell you? We might pass this episode, hopefully without a kind of major damage to real economy, but it is going to be challenge for central bankers, especially in emerging market developing economies, to stabilize these long-term inflation expectations, given what is going on in inflation nowadays. So that's something I think not discussed extensively. The other issue is that the why we care about inflation. What's the most important consequence? Of course, the inflation, basically the prices becoming difficult to forecast. You have higher uncertainty, and that affects investment decisions. You have reduction in purchasing power of people, and when you think about the kind of the long history and what we learn from that history, high inflation is often associated with lower growth, and in the context of emerging market developing economies, high inflation is associated with financial crisis. Uh, when prices increase, you see weaker investor confidence. And then, of course, this undercuts incentive to save and erode financial and public sector balance sheets. So the at the World Bank, we are also worried about the low-income households because the damage of high inflation uh, falls disproportionately on the poor, since poorer households are more reliant on the fixed income, wage income, have less access to the interest-bearing accounts, and are unlikely to have significant holdings of financial or real estate apart from cash. Uh, for these reasons, low and stable inflation has been associated with better growth and development outcomes, financial stability, and poverty reduction. Um, however you cut it, I think the bottom line is that when you have uh, elevated inflation, when you do not have price stability, it is difficult to talk about macroeconomic stability. It is difficult to talk about sustained and stable growth. Back to you.
Thank you for your opinion. So it sounds like a bit of good news that long-term inflation expectations are relatively better anchored than short-term inflation expectations, and the fact that what is really important for household or firms. Consumption or investment decision is long-term inflation expectation feeding back into real interest rates. So that sounds like a good news. But as you said, from emerging market and developing economies perspective, this if this high inflation continues, it will eventually could feed back into long-term inflation expectations, and also distort these real decisions by economic agents that has some these important consequences. So, and you also mentioned about these disproportionate damage toward lower income households and so on. So we might so it's giving the policymakers another headache that they have to care about increasing inequality driven by this inflation surge. And I have a question to you because these days many people are concerning about the so-called wage and inflation spiral, which fits back into each other. So do you think this wage inflation spiral is a concern that is felt quite same between advanced and emerging and developing economies, or what do we know about this wage inflation spiral, especially in emerging market and developing economies?
So the issue is that uh, wherever you look at, uh, you see quite a bit of increase in inflation, and at the same time, uh, that comes with, of course, wage inflation. Now, uh, when we think about the kind of the type of inflation we are experiencing at the global level, of course, the only experience we have, the type of the supply shocks the global economy witnessed, the type of commodity price shocks the global economy witnessed, is the 1970s. And there, these wage inflation spiral played a significant role, pushing inflation to higher levels in making inflation persistent. Now, when you look at advanced economies, you don't see the type of the wage related inflationary pressures we had in the 1970s. And there are good reasons for that. And the most important reason is that the economies are much more flexible in many dimensions on the labor market side, product market side. Um, this does not necessarily mean that the wage inflation is not going to play a role determining how persistent inflation is going to be, but it is going to play a role whether we will see much higher inflation rates in coming months. In the case of emerging market developing economies, again, the type of indexation, the type of labor market rigidities uh, we had in the 70s no longer there. But the type of inflationary pressures related to wages are already creeping up. And it is only a matter of time we will see those pressures translating into headline inflation numbers. Once again, the question is that, let's say inflation is 8% today in a country, it might go up to 10%. But the type of wage inflation pressure, you expect that inflation is going to go to 15, 20%. Will that type of outcome possible? Yes, but the likelihood of that is smaller than what you had uh, 10 years ago, 20 years ago, or 30 years ago, because economies are much more flexible. The big question is that whether we will see persistent inflation at lower levels, let's say around 5%, because you need to provide a certain amount of increase in certain prices, and those prices could be uh, prices we observe in labor markets like wages. But as I said, given the monetary policy stance we see in many countries around the world, uh, uh, we just need to look at the data and see the outcomes. Back to you.
I see. It sounds like a continuous labor market or property market reforms are the key to, avoid this vicious cycle between wage inflation and inflation. Okay, so given the current development of inflation, it seems natural to discuss monetary policy now. So especially by the Federal Reserve. So recently in the November FOMC meeting, the Fed raised the policy rate by 75 basis point. So the rate hike itself was quite expected by market participants, but the chairman Powell also delivered a strong message for a hawkish monetary policy, which shook the market. So, Dr. Spiegel, let me ask your opinion on this front. So, first, what is the main reason for continuing hawkish monetary policy of a stance of the Fed? And second, what are the expected effects of such a monetary policy stance on the real economy as well as the financial markets?
So, thanks for having me. And let me also say that it's a pleasure to reunite with some of my colleagues for a long time, and to start by noting that my comments are my own, of course, and not those of the Federal Reserve. So,
Absolutely.
with that disclaimer, to answer your first question about the policy tightening. Um, I think the way to start, I think Dr. Kose did a very good job of setting the table in terms of the experience we had leading up to the high inflation that we now are experiencing. And inflation has gotten very high in the United States. Remember that the Federal Reserve mandate calls explicitly for targeted inflation around 2%. And now, what we're looking at through the most recent, through the September report prior to the recent meeting, we had PCE price inflation, which is the one that the Fed tends to pay more attention to, of 6.2%. We look at that one more closely because that one seems to be a better predictor of inflation over the medium term than the raw CPI. But then core inflation around 5.1%. Uh, Still a very high number. And of course, as we've been discussing, that kind of a number brings with it real hardship to American households and firms. For households in particular, they haven't seen their wages keep up with the level of inflation that we've experienced to date. And as a result, their so called real wages have declined. And so their purchasing power in real terms have experienced actual declines. And that makes it difficult. And also, as Dr. Coase noted, typically it's the case that high inflation is associated with volatile inflation. And what that does is it creates tension and makes it difficult for firms and households to plan in terms of making investments or making long-term purchases like housing. And for all of those reasons, we have a 2% target and a commitment in the Federal Reserve to stick to that 2% target. Um, Given that, however, the labor market has been extremely tight and continues to be tight in the face of the rapid pace of policy tightening that we've experienced in the Federal Reserve this year. We had a very strong, continued strong job market report just recently for September. It was a little bit moderated, but still, very tight labor markets. Unemployment ticked up to 3.7%, but that's still far below levels that we think are sustainable over the long term. So you have the US economy exhibiting very tight labor markets and very high inflation. And so, although there has been some moderation to date for real activity, um, we did see at the last meeting the Fed raising the federal funds rate by 75 basis points. And the statement, the policy statement accompanying the decision, did say that that the committee anticipated ongoing increases in the target range would be appropriate. So, as you said, that was taken as a statement that implied that more increases were likely to come going forward. And so this was a stance of policy tightening to address this inflation problem. So do you want me just to go straight on to your second question?
Sure. Thank you.
Okay, so your second question was about, what do we expect this to do? And basically that's kind of a question along the lines of, how does monetary policy work? And what the Fed has in its policy toolkit is the ability to tighten economic conditions by raising interest rates. And what that does, it makes it harder to borrow or to invest, or for example, it raises the rates on mortgages, and that makes it more difficult to to purchase housing. Um, the, raising policy rates also uh, pushes up the value of the dollar, as I'm sure many of your viewers are aware in Korea that the dollar has appreciated markedly against the won and against a number of other currencies as well. And all of this is part of the process of slowing the domestic economy. It also impacts on financial markets. Tightening typically elevates uncertainty, and as a result, tightens financial conditions, which can elevate bid-ask spreads on some assets and tighten financial conditions more than they otherwise might be. And what these are parts of the process that are done to restrain the pace of activity. And indeed, that's what we're starting to see happen now. So another thing that was noted in the last statement of the Open Market Committee was that the committee was paying attention to the lags in monetary policy. And so there is a cognizance that some progress has been made to date, but as we know from economic studies, these are long and variable lags, and so it's very uncertain going forward. What the process is going to be, and there's a lot of uncertainty in the amount of policy tightening we're going to need going forward.
Thank you. So, the fact that nominal wages do not really keep up with the increase in inflation, resulting in a decline in real wages. And as Dr. Kose said, this might be a good news from the absence of strong wage and inflation spiral. But the fact that real wage is falling despite, the very tightening labor market may not be a good news for U.S. households and overall. So that made me wonder about some distributional consequence of Fed monetary policy, because Dr. Kose also mentioned about this high inflation is disproportionately damaging toward the poor and the vulnerable. So what is the expected outcome of continuing hawkish monetary policy in this perspective on, let's say, on inequality? Do you have any thought on this front?
Well, it's definitely the case, as Dr. Kose was saying, that those that are unbanked are disproportionately harmed by inflation. And I think it's even safe to say that lower income households are probably more impacted by inflation than for wealthier households that have greater access to assets that can be maintain their value in real terms through more sophisticated investments, and those people that can move their money quickly into money market funds and those kinds of adjustments. Those aren't the kind of households that are going to be the most hurt. But in fairness, all the households are being harmed by inflation, and so this is a problem across the board. What I would say about the policy response is that because of the fact that the poorest households are most adversely affected by inflation, that makes it even more important to get the problem under control and to move aggressively to address the inflation problem before it becomes so entrenched that it becomes very costly to do so.
I see. Okay, so as Dr. Spiegel mentioned, the hawkish monetary policy also resulted in stronger dollar, and U.S. monetary policy has such a strong spillover effect for the rest of the world, especially toward emerging market economies. So this time, I'd like to hear from the other side of the globe. So, Professor Kim, what are the pros and cons of a strong dollar from an emerging market perspective?
Okay, thanks, Sangyeop. I first appreciate the Chosun Ilbo for providing this excellent opportunity for Korean audience and for myself as well. So, regarding your question about the strong dollar, if I go back to when I first met maybe Mark and Ayhan, I was on the job market in 1996 and got a job at the Federal Reserve Board. At that time, almost nobody in Korea cared about what the Federal Reserve does. Excuse me. But these days, all Korean newspapers are watching it. And furthermore, this strong dollar affects the Korean economy in various ways. Most, excuse me, most directly, the trade effect is still a channel, but that channel is not as strong as it used to be. By trade channel, I mean a strong dollar is beneficial to Korean exporters, which means it's bad for US producers, which is still true. But that channel is not as strong anymore these days because, first, in terms of production, there's a huge value chain effect, which Dr. Kose mentioned earlier, is influencing the pricing mechanism. Therefore, the strong dollar is not always beneficial to the Korean exporters. And second, more importantly, there is a huge financial linkage channel where a strong dollar is usually deteriorating the situation in emerging market economies. And even more important is that a strong dollar is not an exogenous phenomenon to emerging markets. A strong dollar doesn't happen randomly. Strong dollar happen for a reason which has consequence in emerging market economies. These days, a huge uncertainty is a reason for strong dollar, which is bad for the emerging market financial markets, emerging market financial markets. In this sense, the strong dollar is not beneficial anymore to emerging markets. And if I have to say, it's on the con side, which is more stronger these days. Back to you.
Right. So traditionally, the trade channel of the exchange rate has been the most important factor. So that I think that's pretty much the reason why, for example, Korea was able to rebound very quickly from the Asian financial crisis through its strong depreciation. But we shouldn't forget that weak Korean currency won or weak emerging market currency in general is mostly driven by strong dollar per se. So in terms of say effective exchange rate, accounting for trade basket, across different trade partner, they no longer have a strong price advantage anymore. So I guess that's why we lost importance of trade channel. And when it comes to financial channel, yeah. So so, Professor Kim, as you said, this financial channel is mainly affecting so-called like balance sheet of emerging market firms or
Mm.
household. So, I guess if that's the true, the adverse consequence of strong dollar must be more significant for countries with higher foreign currency debt. So, do you have any perspective on the foreign currency debt and the strong or adverse effect of strong dollar?
I mean, I don't have, maybe Ayan, you have much better on the data side, but in East Asian markets in general, I think East Asian markets are less affected by the recent turmoil than other parts of the world, that's for sure. But among East Asian or Asian countries, I think we recently heard stories about Laos and Vietnam about the dollar exchange, even on the street, is becoming more and more scarce, which is a bad sign given our own experience uh, in the last century. So that's kind of worrisome. In Korea itself, I don't think we are on that front as much as those countries. But when tsunami hits, you don't know how much higher you should go up the mountain unless it subsides. So the more careful you are, the better you will be.
Right, that's so correct. So despite the fact that Korea,
Mm.
has been reducing its exposure to foreign currency debt, so it's a bit of comfort, but who knows? Okay, so uh, Dr. Spiegel is kind of well known that the Federal Reserve doesn't necessarily take into account its potential spillover effects of monetary policy decisions. Is it true? And if so, what emerging market policymakers should do against the strong dollar?
So I would say that, it is the case that the Federal Reserve mandate is based solely on the achievement of price stability and maximum sustainable employment in the United States. But that does not mean that the Federal Reserve ignores the global economy. Indeed, we can't, because the US is an active participant in the global trading system, and what happens in the rest of the world comes back to affect the US economy. And so we have a big staff at the Federal Reserve who actively follow the global economy, and that's something that we pay a lot of attention to. We also have the policymakers from the Federal Reserve, including Chair Powell and my old boss John Williams, the president of the New York Fed, who was San Francisco Fed president prior to going to New York, attending the G30 meetings and other official meetings to talk to other central bankers and policymakers around the world. So the Federal Reserve is paying a lot of attention to the global economy, but it is the case that the lessons that they're taking are being used to achieve the mandate for the United States of price stability and maximum sustainable employment. That all being said, I think Chair Powell gave a very good answer to a question quite similar to this in the press conference following the last FOMC meeting, where he noted that the best thing that the Federal Reserve can do for the global economy is to get the U.S. economy's house back in order by rebalancing this tension between the excessively tight labor markets and the high rates of inflation, and bringing things back to a more normal state of affairs. As the chair said, over the longer term, maintaining price stability in the United States is very important, not only for the U.S. economy,
Mm.
but for the global economy as a whole.
Right. So yeah, it's kind of comforting that the Federal Reserve also cannot simply ignore its the effect of its action for the global economy, and what is good for the U.S. is also good for uh, the global economy as well. So, based on all your opinions and thoughts, it seems like we have to bear with such a strong and hawkish monetary policy for a while. And as a result, we will continue to see a strong dollar. This makes me worried about currently worsening financial market conditions. So, global financial markets are currently quite under quite some stress, and maybe the fiscal problem in the United Kingdom is one example. Professor Kim, what do you think of this market distress, and how long will it continue?
So you mentioned you mentioned the you mentioned the United Kingdom case, and then yeah, even the prime minister had some story with the prime minister as well. Rather than go into the details of that, similar things happen in various parts of the world and even in Korea. And most of the audience, Korean audience, would must have heard about this Legoland uh, incident and the 흥국생명 incident. And then those could be a very small story on a normal situation, but right now the situation is not as normal as it we hope to be. And in this tight monetary policy environment, a small market distress would become a big event in a very casual manner, and because there might be a cascading effect once a small things happen, and then we cannot tell where it would evolve to, right? So in my experience of 2008, I don't know, the Mark, you have also experienced from the San Francisco side, but when I was in Federal Reserve Board, I mean, some things happen, and then we cannot tell how big the effects would be, to be frank. And then some things got kind of rolled over like a snowball to a very big event very fast, and it's very hard to tell. So for Sangyeop, for your last part of the question of how long it continue, yeah, that's I don't think anybody would can tell about it. Yeah, because nobody has the crystal ball.
That's true. But as you said, yes, during normal time, maybe a little bit of bankruptcy here and there might not cause a systemic problem, but definitely under this already tightened financial market and hawkish monetary policy is going to add some uncertainty to the market participant, which amplifies the adverse effect of those incidents. Right. So.
Sure.
And as Professor Kim already mentioned, current market distress is not simply driven by monetary policy tightening per se. So, Dr. Spiegel, can you say more about the cause of the distress and perhaps provide some policy suggestions to alleviate the distress?
So it is the case that we're seeing tightening of financial conditions in the global economy. We're seeing in the U.S. market, in particular, notably the U.S. Treasury market, which is a very big and deep market and a bellwether for financial conditions across the globe. Some signs of, I wouldn't say distress, but we're seeing some reduced market depth, less open orders among dealers, a little bit of increase in bid-ask spreads. But those kinds of markets are continuing to function normally. So even though financial conditions are tightened, we're not seeing. So I think it's a little bit excessive to characterize it as financial market distress, at least at this point. We know that there's an ongoing policy tightening across the board, not only from the United States, but in other advanced economies, central banks. And so things are continuing to progress. But for now, I think it's safe to say that the major financial markets are handling the situation. What is it coming from? Well, as you said, partly there is this tightening of monetary policy, but that's not the only story. Clearly, the geopolitical situation, the Russia-Ukraine war, has elevated energy prices and has caused a lot of, and wheat prices as well. And so we're seeing some impact in oil and wheat futures markets. Um, so there are not, but in general, there's just a lot of volatility right now associated with those factors. There's also a lot of uncertainty about, going back to what Dr. Kose talked about originally, this sort of rapid recovery from the pandemic and the resulting need now to tilt activity from the goods sector to the service sector across the globe is causing a lot of uncertainty in terms of how firms can plan and how much they need to produce. And so all these things come back to roost in the financial markets. And so for a variety of reasons, we're seeing these kinds of sources of volatility come home and impact on financial markets. But to having said that, although we have seen some increased bid-ask spreads and other things are apparent, the financial markets have weathered the increased volatility to date pretty well. I think that's a fair thing to say. There are concerns, I think we've talked about it already, of countries that have large outstanding dollar-denominated debts. And it's kind of a shame because there was such we were in such an environment in 18 and 19 that the countries that took on this extra hard currency exposure were not compensated for it very much. It really was, in retrospect, kind of not a great decision, but given these existing hard currency exposures, that's going to cause some distress going forward. In terms of the policy, uh, I'm not going to give policy advice to other countries, but in the olden days, like right after the taper tantrum episode of 2013, when a number of countries, emerging market economies in particular, found themselves facing worsening credit conditions globally. Actually, Chair Powell, who was then a governor in 2014, gave a speech at our bank's policy conference and showed a chart of how countries fared during the taper tantrum kind of crisis, which was another period where emerging market economies had difficulty raising capital. And what it showed, and Korea, I think, came out, I think Korea was in the sample. Korea looked very strong in a relative sense because of the fact that it had kept its house in order prior to the taper tantrum in terms of maintaining a low current account deficit and the kinds of things that when the shock hits, they were better prepared to take it. So that's an easy thing to say, and that probably applies today as well. I'm more hesitant to say that, though, currently, because of the fact that what we're talking about now is countries in a position that they are in because of the pandemic. And during the pandemic, a lot of countries took aggressive, including the US, policy actions to avoid the severity of the downturn. So, to some extent, through a situation that was not so much anyone's fault, some countries are finding themselves now in quite exposed positions, and that is a cause for concern globally.
Right, thank you. So the lesson here is that, despite the tightening financial conditions, we haven't received a serious liquidity problem in major financial markets. So we maybe shouldn't worry too much about, the a financial crisis or anything like that at this point. But as Dr. Spiegel said, nevertheless, its consequence on emerging market with a little bit of weaker financial depth and institution could be different. But also, COVID-19 is whole different story than before. So, stronger fundamentals that were used to work may not be necessarily working in this new era of post-COVID-19 global economy. All right. So thanks for sharing your views on financial market conditions. So we have a very important event on the calendar. The U.S. midterm election is actually tomorrow. So the U.S. market is closed a bit higher today, perhaps with the possibility of a policy shift. And I understand that Dr. Spiegel and Dr. Kose are not really in a position to say something about the election. So I have to ask Professor Kim. So, Professor Kim, do you expect any shift in policy stance depending on the outcome of the election? If so, what are the upside and downside risks of such a policy shift?
So I think the markets improved a little bit, not as much as the outcome of the election is on one side or the other. So I would rather say the uncertainty is nearly resolved. We are only one day away from the election, and then no matter what the outcome is, unless it's extreme in either way, markets always love the resolution of the uncertainties, and that's what will happen. Of course, there are some cases of a very prolonged the ballot process, but I hope it doesn't happen again this year. And by about this time in Korea tomorrow morning, we'll maybe hear stories about the election result here and there. And if you focus on the monetary policy, I don't think there are much changes at the Federal Reserve unless the election results are again extreme either way. I mean, of course, there are some commentators talking about or gossiping about who nominated Jay Powell, right? I think the Mark mentioned that Jay Powell gave a speech on taper tantrum in 2014, and tantrum was in 2013. So if my memory serves me right, Jerome Powell came to the Federal Reserve in 2012, right? So you can tell who the president was then. And then also the political commentators gossiping about who nominated Jay Powell as a chair, right? So at the political side, but that's for fun, for sure. But I don't think the federal system is as weak as to be affected by the political commentators. In a nutshell, I think Federal Reserve System is a very strong institution, and in that sense, the stance or political sphere would not change monetary policy much. However, from a Korean perspective, what may matter, though, is that the new Congress after the election would direct the trade issues, and that will govern the G2 conflict, which both Spiegel and Kose mentioned before. And then this G2 conflict between G2, I mean the US and China, G2 conflict itself would be a trade risk for Korea, but also it is a financial risk for all countries around the world. And in that sense, Korean markets are kind of the riskier or the more fragile than in many other financial markets for a similarly ranked countries in the world. Back to you, Sangyeop.
Right. So thank you for sharing your experience at the Fed with us. So as you said, right. So central bank, especially Fed, has a strong independence from the government or politics. So I agree with you that the monetary policy stance itself wouldn't really change depending on the outcome of the election, but its industrial policy might be so, which has some consequence on the Korean economy. Okay, so Dr. Kose, I have a final question to you. So there is a growing concern. So as Professor Kim already mentioned about the G2 conflict between US and China, so that could be one example. So there is a growing concern about the so-called deglobalization, especially since the COVID-19 pandemic, because of global supply chain disruption, travel restriction, and so on. So, do you think such a concern is valid? And if so, what is the main reason for that? And what can we do to not lose the degree of integration we have achieved over the past few decades?
Yes, Sangyu, this is a very serious concern. When you think about global economy over the past 3 decades, uh, there has been a kind of great embrace of openness to trade, openness to financial flows, and now we see a serious risk of fragmentation of networks of trade, the financial flows, investment, and digital connectivity. And even prior to the pandemic, as Dr. Kim alluded to, there was serious friction between two major economies, US and China, in the context of trade issues, and that had serious repercussions. With the pandemic, obviously countries realized that uh, there are serious disruptions of supply when you basically have a narrow base of suppliers for certain products. And the war in Ukraine has heightened the risk of fragmentation. Um, the the type of rules-based international order, which is a very important global public good, has been threatened by the war, and of course the emergence of certain frictions between major economies. So there are good reasons to worry about deglobalization or the fragmentation of networks of trade and financial flows and investment. Now, the challenge is that we know openness to trade, openness to foreign direct investment, these are closely associated with positive technological spillovers, lower trade costs, and over a longer term, better growth outcomes. And I think that the past 3 decades, the type of the reduction in poverty we have seen around the world has been attributed to the forces of globalization becoming more intense. And you look around the world, you see global value chains, and after the war, there are strategic reasons. Countries basically see the need to shorten these global value chains or absorb these global value chains, and with the serious geopolitical tensions and increased risks associated with geopolitics, there is this possibility of certain fragmentation. Having said that, um, well functioning and diversified global value chains are a source of resilience far more than they are a source of vulnerability, as lots of people argued during the pandemic. Yes, the participation in global value chains may increase exporters' vulnerability to foreign shocks, and we saw that during the pandemic. But at the same time, it reduces their exposure to domestic shocks. In addition, when you think about reshoring of production, that can lead to sustained welfare losses. Ultimately, we need to think about, of course, comparative advantage considerations. Now, what should policymakers do? I think policymakers first need to refrain from putting in place protectionist policies. And unfortunately, over the past 6 months, we have seen different manifestations of that. Uh, for example, think about the increasing commodity the prices, especially food prices, and the type of export restrictions countries have been putting when it comes to the food products, the grains, wheat, etc. What we know very well from previous episodes of these food price shocks, when you introduce these types of restrictions, uh, these restrictions magnify the increase in prices at the global level. So, in a sense, when countries undertake these types of restrictions, they are uh, putting in place policies that are counterproductive, that are not helpful. Now, what should countries do? I think they should favor multilateral measures that promote the resilience of global value chains, reduce the cost of trading, and ultimately facilitate capital flows. There are, of course, cyclical reasons why we see a substantial decline in capital flows related to interest rate increases. Now, the types of policies that need to be put in place when you think about the vulnerability of global value chains, we need to encourage firms to diversify trade partners as well as inputs, especially in key strategic sectors. There is nothing wrong with that, and they need to put in measures that streamline border procedures and ease impediments to trade flows. Now, uh, investment we need in many places, but we need to have investment promotion capacity, and we need to find still ways to expand preferential trade agreements, so we have overall basically decline in the cost of trading. Uh, we think that it's important policymakers favor policies that deepen integration into the global value chains. Uh, they can include, they can basically modernize trade information and digital systems, strengthen contract enforcement, and address basically market distortions, facilitate trade finance, and foster competitiveness. uh, the, uh, the biggest loss uh, with this fragmentation of trade and the investment networks going to be borne out by emerging market developing economies, and those economies definitely need markets. They need the capital, and they need to find ways to generate income. I think that the rules-based international order is facilitate better outcomes, and we need to find ways to strengthen that system rather than weakening it. And I'm hoping that policymakers are going to find ways to basically overcome the current challenges and strengthen the system that has really helped greatly when you look around the world, especially the emerging market developing economies. Back to you, Sang.
Thank you for your very clear diagnosis of the current state of the economy and the state of deglobalization, and also insightful policy advice. So you mentioned about those key strategic sector, and Russia's invasion of Ukraine is one of the justification of reshoring in this sector. But as you said, it could be another reason to even more diversify the trading partners in this specific key strategic sector. So I fully agree with your comment on this. So, this fragmentation of the global economy is not really limited to the problem of economics. If this deglobalization and fragmentation and, polarization continues, it could speed over to, the rest of the life, like including, humanitarian stuff. So, thanks for your thoughts. So, as for the last question, I'd like to hear your opinion about the Korean economy. So Professor Kim already touched upon this issue here and there. So we have had a good balance between the global economic outlook and as well as Korean economic outlook. But still, this is Chosun Ilbo's webinar, and we have many domestic audience. So we still want to hear something about the Korean economy. So to give you guys some background, so currently, rising household debt combined with surging housing prices has been the most important concern of policymakers. At the same time, growing debt puts the Bank of Korea in a very difficult position to choose between price stability and financial stability. Professor Kim, so what should the Korean government and the central bank do about it? And Korean firms are also anticipating a recession coming, and tightening financial conditions make them more difficult to borrow these days. So, do you have any recommendations for the business sector?
So for Korean economy in general, I fully agree with Ayan's comment on the multinational effort to become a leader in the world, to be a true top 10 country in the world. Korean government, as other governments should do, and the Korean government should follow the advice and then become a real leader by not doing this protectionist policy and so forth, which I fully agree. On the domestic side, I think the most important one is the coordination between macro policy and micro policy. By macro policy, I mean the monetary policy in general, as we discussed with Mark in detail. On the micro side, it's more on the financial distress story we talked about, and maybe this housing and the housing debt to housing price story could be a micro story as well. And then in a difficult time, it's always that the macro story and micro story conflict with each other, and how to balance the two, and there might be a difficult policy mix. That's what's needed in this juncture for Korean economy. So if I lastly mention briefly about the business in Korea, so I think at this time of tsunami, I think the survival is unfortunately the best guide. And since when a tsunami comes, we should run to the top of the mountain as much as we can, as fast as we can, until the tsunami gets away. What's the best way? That depends on each business or each firm. But to make you as robust, and I like the word the word Kose used, resilient, yeah, as resilient as possible, so that you can survive this perfect storm. And after it's over, you are the one who can start functioning again to catch the opportunities. And then, unfortunately, I think that's the best advice one or any economist can give. Back to you, Sangyeop.
Right. So it seems like the authorities should do their best to not conflict those micro level policy with macro policy, such as monetary policy. All right. So thank you very much, Dr. Spiegel, Dr. Kose, and Professor Kim for taking the time to participate in this webinar and share your deepest thought with us despite your busy schedule. So as an economist, I also learned a lot from the discussion today, and I'm pretty sure that the same goes to the audience. So hopefully I will have a chance to meet you guys in person in the very near future. So thank you again.
Thank you.
Thank
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 you.
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 Great meeting you.